Welcome, everybody. Today's session is called Tax Deadline Strategies and Real Estate, and we have two of the country's finest accountants with us. We have Gerry Hogenhout and Neal Winokur. Gerry is from Canadian Investment Services and Neal is from realtytax.ca. Both these gentlemen specialize in the area of real estate. Neal, in particular, his company focuses on doing tax returns for real estate agents. Gerry does real estate agents and others too, and does a lot in the area of real estate investors and self-employed. So today is an open forum. I've got a few questions, but it's open to people to post questions, or they can just ask them if they want. And just wanted to say, guys, I appreciate you taking the time, because I know it's an extremely busy time right now. So appreciate you taking the time to be with us. I know there's a tax deadline coming up. Let's start this time. We'll start with Gerry. Last time we started with Neal. Gerry, can you help us understand the deadlines? And one thing I'm wondering about, I know they say self-employed deadline June 15th, but is it different if you're incorporated versus, let's say, sole proprietor? Or is that, do both of those meet the definition of self-employed?
Hey, yeah, thanks, David. Good morning, everyone. Thanks for joining. Thanks, David, for having Neal and I on the session today. Great topic. Everybody's interested in tax. So as far as the deadlines, yeah, June is a busy month for us as accountants. I'll just kind of go over we have basically four big deadlines in our world. Three of them basically personal, one of them corporate. So February 28 is a big deadline where we have to file all the T5 dividends as well as T4s for clients. That's a big deadline. April 30th is a big deadline, and that is a tax deadline for anybody any personal tax filing that does not include a self-employed person. If you are self-employed, then we have till June 15th, and that's the one Neal and I and other accountants are scrambling to make sure that we get our returns filed by that date. And then there's another big deadline. It falls into the corporate world, and it's June 30th. And how that works is basically with a corporation, you have 6 months from the fiscal year end to file your corporate tax return. And there's a lot of corporations that use calendar year. So they use December 31st as a corporate tax year end, which means we have to file their corporate tax returns 6 months after, which becomes June 30th. So we in the accounting world have two looming deadlines coming: June 15th for the self-employed people and June 30th for all our calendar year corporate clients.
Okay, so, but again, Gerry, the definition of self-employed is is it June 15th, whether you're incorporated or whether you have a sole proprietorship or partnership? Is it all the same?
Okay, so June 15th has nothing to do with the corporation. Okay, it has to do with the personal tax return. So, for example, if you had a corporation and if you just had a T4 from that corporation, then again, a T4 person would be required to file by April 30th. Just because you have a corporation does not mean you are a self-employed person for tax purposes. What determines whether you are a self-employed person for personal tax reasons is whether you have whether you fill out the form T2125, which is a statement of income. So if you have that, so in most cases, it's if you're a proprietorship. So if you're running a business that is not incorporated, most of the time that will land you at a June 15th deadline. It's not uncommon for us to have a client with a corporation and they have dividends only. We certainly use dividends a lot as far as remunerating the corporate owners. And for some reason, if we miss that April 30th deadline, we are allowed to put $100 of self-employed income on that tax return. Now, all of a sudden, we go from April 30th to June 15th. So again, it really depends on the June 15th deadline is dependent on whether your personal tax return shows self-employed income on a certain line. I forget what line it is, but that's the whole key. If you show self-employed income on that line, then we have a June 15th deadline.
Okay, got it. So now let's go over to Neal for a moment. Neal, I know you've been working with a lot of real estate agents who have been incorporating personal real estate corporations. How is this affecting real estate agents from a standpoint of taxes? Are they saving a lot of money typically? And what are the deadlines and issues that you're seeing for real estate agents now?
Yeah, so what's interesting is in the year that realtors incorporate, so for example, realtors who incorporated in October or November, December of 2020, their 2020 tax return is, we just got through this filing season, and what basically the main issue that we had to watch out for was the T4A slips that the realtors receive from the brokerages. We noticed that because there's a certain date once they incorporate where they basically will have two T4A slips in that year. The first T4A slip is from January 1st until basically the date they incorporate. And that will include all the commissions they earned as a self-employed sole proprietor realtor. And then the T4A slip for the end of the year would be issued to their new corporation. And each one has a separate HST number. So we had to be very careful to make sure that the brokerages issued the T4A slips correctly and they weren't double counting income, like income wasn't being recorded both on their personal tax return and again in the corporation. So that was the one. Realtors have to be very careful in the year that they incorporate, whether it was last year or whether now in 2021, more people are incorporating. You have to really watch out for this to make sure that the T4A slips are correct. But the deadlines are the same as what Gerry was saying. So June 15th for the personal tax return if they have the self-employment income, and the corporations, if it's a December 31st year end, they have until June 30th. The only thing I would add for these realtors is the tax, what's sort of like strange in our tax system is even if you have until June 15th to file, but your income taxes payable are still due on April 30th. So a lot of self-employed people always ask that question, wait a minute, I have until June 15th to file, but I have to pay by April 30th. So there's always like this confusion we have to explain to people. And the HST return is the same. So a self-employed person who has to file the HST return, it's also June 15th filing, but they have to pay by April 30th. If they weren't paying installments throughout the year for whatever reason, I mean, they'll still have interest on that. And with the corporation also, you have until June 30th, 6 months from the year end, but you have to pay your tax by March 31st, 3 months after the year end. And you have to file the HST return for the corporation by March 31st. So a lot of these realtors in the first year they're dealing with the corporation, they had no idea that they had to file a corporate return by June 30th, pay their corporate tax by March 31st, file an HST return by March 31st for the corporation. That was very new to them. So a lot of these deadlines in the first year when a self-employed person incorporates a new corporation, the deadlines are different and it's new to them. So we kind of feel like we're holding their hands through this whole process. There's a lot of hand holding and a lot of explanation that goes on.
Okay, I understand. Neal, are you seeing real estate agents save a lot of money now in their taxes? And is there a rule that says, if I earn this much money, then I should incorporate as a real estate agent or not?
So what we saw in 2020, if realtors who incorporated October, November, December 2020, they were actually able to save a lot because if they were already in the highest tax bracket in 2020 from January till September 30th, let's say, all the remaining commission income they earned from the date they incorporated at the end of the year, all that commission income went into their corporation where they have a 12.2% tax rate. Whereas personally, they might have had a 53% tax rate in Ontario if they were already in that highest bracket. So people were very happy that they were able to save quite a lot. And you could show them exactly what they would have paid if all that remaining income at the end of the year went into their personal return. So people were very pleased with that. I don't think there's a specific number where it becomes advantageous to incorporate. I think it really depends on the person. I think the general rule of thumb is like, if you're able to leave money in the corporation, which you do not require for your personal use, you will have a tax advantage. Whereas if you know every year you need all the money from your corporation for whatever reason, there still could be an advantage, but there might not be. It depends on the situation. So what we tell people, we ask our clients, how much money are you going to make? Like, what will your estimated income be? And of that amount, how much do you need every year for your personal living budget? And if there's a difference, even a small difference, it usually makes sense to incorporate. And that's generally how we look at it.
Okay, thanks. Gerry, what are you seeing? Do you agree with Neal in terms of, what point a real estate agent should incorporate? And I mean, how much money are they saving now?
Yes, 100%. I agree with Neal. And in my opinion, most real estate agents are saving money. Now, again, let's categorize real estate agents for a second. There are those that are running very, very, very successful machines and making a lot of money on one extreme. The other extreme, there's the real estate agent that is quite content selling 1 or 2 houses a year as a part-time job. So certainly the real estate agents that are working their industry as a full-time business, I would think all of them probably would benefit in one way or another. Now, Neal hit the magic bullet by saying, if you need all the income you earn, if you net $100,000, and if you need $100,000 personally, yes, it can flow through your corporation, but if you're pulling it all out personally, there's a question of how much money you're actually saving. The whole key to this thing is earning residual income. If you made net $100,000 and if you only needed 50, then the residual amount of that money is retained in your corporation. That's where the magic happens. That's where you save a ton of money. But also, I see a lot of clients that, for example, let's say you net $50,000. So it doesn't matter what your gross is, your expenses are deducted, and let's say you net $50,000. Probably that's not going to save somebody a whole lot of income taxes.
Hector, please mute yourself, Hector. Hold on, I'm trying to find Hector. No, I think it's Hector. I'm trying to find him to mute him. There we are.
Okay, so yeah.
Maybe not. Okay. Not sure what that is.
I gotta. So if somebody even netted $50,000, from an income tax point of view, there may or may not be a point of using a corporation. But when you add the Canada pension plan issue to that equation, somebody makes $50,000 as a salary or self-employed, you're going to pay over $6,000 of Canada pension. If you earned that same income through a corporation and gave yourself a dividend, you're basically paying zero personal tax, and you're not paying any any Canada pension plan. So if you, again, back to 50,000, if we float net, this is net, so it doesn't matter what your gross less your expenses. If you net 50,000, if we flow that through a corporation, you're going to pay your 12.5%. You can take that out as a dividend, almost tax-free, very low personal tax rate, and you eliminate paying any Canada pension. Now, that's a whole conversation on its own. Some people want to pay into their Canada pension. Other people will do anything to not pay that $6,000 annually into their Canada pension. So from a planning tool, again, a corporation gives us another advantage that we can address that issue with the client. And again, when they go, gee, should I put money into my Canada pension? I mean, now that I have an option, once again, I've said it before, these personal real estate corporations become great vehicles for saving money for the future. You know, I call them the real estate RSP. You don't need an RSP. You need to use your corporation in an effective way to build a retirement plan using your corporation. The Canada pension, if we analyzed how much money all of us put into the Canada pension compared to what we get out of it, it's criminal. So to sit there and put all this money into the Canada pension and say, oh, good, I get $500 a month when I'm 65, it just makes no sense. So again, with the corporation, with the personal real estate corps, we have the added advantage of really using that vehicle to for a bigger purpose, not only to save tax, but to really set yourself up much more effectively from a retirement planning and even an estate planning point of view. So your corporation can easily become your own RSP.
Okay, very good. So now we've got some questions coming in, and in no particular order. Well, I'm going to take them in this order because it's relevant to what we're talking about now. Holly is asking, the funds left within the corporation can be invested, correct? What's the best way to take money out of the corporation? Neal, do you want to take a crack at that one, or?
Maybe I'll let Gerry, because
Okay.
Gerry specializes more in the investment
Sure.
side of it.
That's fair.
Yeah,
Yeah.
sorry. So sorry, taking money out, that was okay. So again,
I
just
guess
follow
it's a two-part question, I guess. The funds can be the funds that are left within the corporation can be invested, correct? That's part one.
Yes,
And then right.
basically, in a corporation, you can do anything that you can do yourself as far as investments. Okay, so we look at these corporations as investment vehicles. Okay, now as far as the second part of the question, as far as how to take money out of the corp, basically think of it in simple terms. You can take money out yourself as either a salary or a dividend. Okay, that's how you get the money back to yourself. Now, you also have what we call a shareholder account, which means if you put money into your corp, or if you put an asset into the corp, you can take that money back out tax-free. Okay, so I know that confuses a lot of people, especially realtors who have never really used corps. Let me back up a little bit. When somebody is self-employed, i.e. they do not have a corporation, and that's the way realtors have filed tax returns forever up to this past year. If you're self-employed, proprietorship, the tax system does not care what you take out of your business. They're going to tax you on your net income. They're going to look at your gross sales minus your expenses equals your net income. Your net income is going to go on your personal tax return, and you're going to pay a tax rate on that. The system does not care what you take out of your proprietorship. Now, moving forward, today, all these realtors have the opportunity to incorporate. A corporation is a separate legal entity. So now CRA does care what you take out of your corp. So follow the logic. Your income gets flowed into the corp. There's a 12.5%, 12.2% tax rate up to the first $500,000 of taxable income. Now we can make all kinds of choices. If we give you a salary or a T4, now that becomes a deduction from the corp and it becomes taxable to you. So that's one option. Another option is we can give you a dividend. A dividend is not deductible to the corp, and there you have tax savings personally through a dividend tax credit. Another option, shareholder account. If you have if you've contributed money to your corp, you can take that money out again tax-free, because now this tax system does care what you take out of your corp personally. So without really over confusing everything, we just have a lot more tools as accountants that we can do to minimize that tax. And again, when we use our corporations as investment vehicles, we can strategize over your life. Okay, we want to build up those what we call 87.5 dollars. We pay the tax, we retain the money. That's a lot of residual net income compared to what a lot of realtors have been paying. A lot of realtors are paying 50% tax, which is crazy. So now if you're retaining 87.5 cents of your dollar earned, you've got a lot more money to do something with. And there's so much stuff you can do in your corp. Your corporation becomes a really good vehicle. Again, I'll repeat it, to plan your retirement and estate planning over your life. And we can take money out of your corp over your life in a very tax advantaged way, much more than it is in the past with a proprietorship. So to answer your question, yes, we can use those corporate vehicles to invest in anything that we want to invest in. And we can certainly, Neal and I, other CPAs, we have more tools, we have more strategies to get that money out of the corp into your hands personally. But certainly the goal is to get that money out of the corp into your hands personally. And when it doesn't, so now you have a corp, you have all kinds of money in that corp. And again, we do a lot of estate planning. So you're going to die. And you're going to have lots of money in your corporation. What happens then? Well, you own a share. The share is an asset. Okay, that's going to flow through your estate. Oh, and I should mention, anybody with a corporation, you should strongly consider having what we call multiple wills. Okay, and the reason I mentioned multiple wills, getting off topic a bit, but I think it's important based on our discussion. Most of us have a will, and in our will, we pass our assets to our loved ones and our beneficiaries. That anything going through the estate, there's probate. If you have a multiple will, which is just a second will, only for the share of your corporation, that avoids probate. So I don't want to go much deeper down that rabbit hole, but if you have a corporation, especially if you have a corporation with a lot of money in it, so all these realtors that are now retaining 87.5 cent dollars are going to build up a lot of money in their corporations in their lives. So the cost of a multiple will is nominal. It's nothing. You can do it yourself. So just be aware of that for those realtors that are building up a lot of assets in their corporations.
Very interesting. Thanks, Gerry. Neal, here's one I'll ask you from Cam. He says, can real estate agents incorporate and protect themselves from personal liability?
My understanding is that the liability, you still, as a realtor, your liability insurance that you have to pay every year, I think it gets paid to RICO or whoever, that doesn't really change. I'm pretty sure, like, it's not a professional corporation, right? So the personal real estate corporation, it's not like how accountants or lawyers or dentists, they incorporate what's called a professional corporation. This is really just like any other, small business corporation, CCPC. That's Canadian controlled private corporation. So from a liability perspective, I mean, it's more of a question for a lawyer, and Gerry can chime in here, but the liability is you still have your liability insurance as you always had. I'm not exactly sure if you need to have additional liability insurance. Our understanding is that your liability insurance is pretty much the same as it was before. But I could be wrong. I'm curious to hear what Gerry has to say on this one.
Gerry, do you have any thoughts on that one?
Yeah, so the personal real estate corps, the PRECs that we know them as, they're designed really for any other activity other than your real estate activity. Okay, so you can't use your PREC to hide behind to say, hey, I'm a realtor and I buy and sell real estate, and if anything goes wrong, you can't sue me because I have a corporation. That does not work. The PREC is not allowed. You are not allowed to use your PREC to conduct business as yourself as a realtor. Okay, all the PREC is there for you to flow your income through. So from a liability point of view, nothing changes in your world. Nothing is different now that you have a PREC. You have to still maintain your insurance like you always have. But on the topic of insurance, now that was a discussion on liability insurance for the daily activities that a realtor goes through buying and selling real estate. If we still talk about insurance, but move it from liability, The PREC, the Personal Real Estate Corp, is an incredible vehicle to use to have a corporately owned insurance policy. Okay, it's incredible. We're retaining 87.5 cents on your dollar in your PREC, assuming you do not need that money to pull out personally. We have a great opportunity to build enormous wealth within a permanent life insurance policy that can be corporately owned by your corporation, funded by your 87.5 cent dollars. And it creates a humongous financial planning tool for you later on in life, because these policies are designed to not only cover the tax liability on your death, they are designed to create massive wealth for you in your lifetime that you can pull out tax-free. Incredible. I don't want to go too deep down that rabbit hole, but we're talking about insurance. Humongous opportunity for all these realtors that have, that are building up money in their corporations to use a permanent life policy. And in fact, if I can, one problem we have, if everything is great and you're doing all kinds of business and you're building up money in your personal real estate corp, one problem is these new rules that the Liberals brought out recently, which is a tax. So keep it simple. If we build $1 million or even $500,000 inside your PREC, and we invest that for 10%, okay, so we got 500 grand times 10% is $50,000 that we're earning in our PREC. Anything over $50,000 of passive income, we are going to jeopardize that 12.2% tax rate. Okay, so without getting into the complexities of all that, when we have these PRECs and they become somewhat successful, where there's significant amounts of money, we're shooting ourselves in the foot a bit as far as accessing our 12.2% tax rate. One way to do that is to extract that money, and not even extract it out of the corp, but inside the corp, we create a permanent life policy. We put that money that the corporation has, their 500,000, their $1 million, into that policy. Now, all of a sudden, the income that that policy earns is not taxed within the corporate structure. It's complicated. I don't want to go too deep into that rabbit hole, but it's again a humongous opportunity for these realtors. And we use those vehicles. They become assets within the corp, and they become vehicles to fund not only your retirement on a tax-free basis. You can pull tax-free income out of these policies. But as far as your estate, we all want to leave money to our loved ones, and using these type of vehicles, it's your estate on steroids, I call it. But anyway, that's a pretty deep topic, so I don't want to really go too deep into that today.
Okay, Gerry. Well, also I want to, a bit later in the call, I want to ask you a little bit about some of the real estate projects you're doing, because now that real estate agents especially have more money left over and they love real estate. I know you've got some different things on the go, apartment buildings and whatnot. But Neal, there's a couple of questions. I wonder if you want to take a shot at either one here. Anna Cooley is asking, how does this change if the realtor is already over 65? I'm not exactly sure what she's referring to there.
Yeah. I think
and then there's another one by Rick McGrath. Is there advantage to holding your private res in a corp and renting it to yourself? Any comments on either of those ones?
Yeah, you can't. Okay, you can't put your principal residence into a corporation. It doesn't really make any sense, and you jeopardize your principal residence exemption, and you can't. It's considered personal use, right? So you can't use corporate funds for your personal use, and that's considered a personal use. You would have to take the money out of your corporation, declare it as salary or dividends, like Gerry was saying, and then you purchase the principal residence through your personal name, which is what you want to do anyways, because you want to get the principal residence exemption when you sell the house in the future. Although, of course, now there's all this talk and rumors about, is the government going to introduce some sort of tax on the principal residence? I think we talked about that last time. But yeah, you can't use like corporate funds to buy the principal residence. That doesn't work. I wouldn't mess around with doing that kind of thing. The question about over 65, I think she's referring to like, if you're a realtor, you're over 65 years old, should you incorporate? And that question, I guess it really depends on, well, if you're over 65 years old, are you already look at your current income? Are you already collecting kind of CPP? Are you collecting old age security? It actually could be advantageous to incorporate, because if you're collecting old age security and you have taxable income, I think it's once you reach about 78 or 79,000 of taxable income, they start to claw back your old age security, and you lose it entirely once you hit about 128,000 or something approximately of income. So if you have too much income in those years, it could negatively affect all sorts of things. There's a bunch of there's an age tax credit that you lose out on if your income is too high. And once you turn 71, or after you turn 71, if you have RRSPs, those RRSPs start coming out at fixed rates. There's forced withdrawals. So you might end up in a very high tax bracket. So the corporation, just like Gerry said, it's another tool that you have. It's almost like having another RRSP, except it's way more flexible because you have complete freedom of choice. It's amazing that today the government seems to never allow us to have any freedom of choice to do anything anymore. But here is an example where you have some freedom of choice in terms of when to withdraw the money. So unlike a traditional RRSP, you must take the money after you turn 71. The money starts coming out whether you like it or not, and you have to pay personal tax. The personal real estate corporation, after you turn 71, you get to choose. You could keep all the money in there until the date of death. You could start taking out a little bit each year. You can time it and you can smooth out your income. So it's a great tool. So even if you're over 65 years old, it's still worth, I think, getting a consultation from your tax advisor to see whether this is beneficial for you or not. It may or may not be, but it's still worth it to look into it for sure. It's almost like the personal real estate corporation, in a certain sense, it's the flexibility level is more comparable to a TFSA, right? The TFSA has no rules. When you're retirement, in your TFSA, you can take it all out, you can leave it all in, you could take out a little bit, you can do whatever you want. So the personal real estate corporation in that sense is more like a TFSA. Of course, when you take money out, you have to pay tax, salary, or dividend, but it's definitely allows more flexibility.
Okay, Neal, I have a question for you. I think, like, if I was to refinance my house or take a line of credit on my house and use that money for down payment on an investment property, the interest cost on that new money borrowed is tax deductible, correct?
Yes, if
Okay.
it's for investment purposes, it should
Right.
be, yeah.
Okay. Now, what if I can't get a line of credit, but I can just get a new first mortgage? So let's say I have a $300,000 mortgage on my house. I refinance. Now I've got a $400,000 mortgage. I've got $100,000 of new money, and I use that. Am I going to have an issue down the road? Like, I heard the term once, an accountant talked about commingling. Like, how do I show that the interest cost or a portion of my interest cost now that I've borrowed when I'm getting one mortgage statement and all the interest costs for my $400,000 mortgages lumped together? Can I still, separate it and write off the interest costs, would you say?
That's a good question. There was just an article in Financial Post, Jamie Gollenberg wrote about interest deductibility and how people run into trouble because there's certain requirements that the CRA has in order for the interest to be deductible. In this case, I actually don't know offhand. I'm sure Gerry knows. Maybe Gerry, you can chime in here. I would think it would still be deductible in theory, but from a CRA audit, if the CRA audited the interest deduction claim, you'd have to prove to them that that interest is not related to your principal residence.
Gerry, do you want to comment on that?
Yeah, I'm glad to chime in. So yeah, it's a very good point. And it does create some complexities and confusion. Excuse me. Yes. So we can borrow, if we borrow money for investment purposes, it is tax deductible. That's a pretty simple standard comment. We also need to prove it. And that's where the complexity comes in. So the easier it is for us to prove it to CRA, for example, there's the mortgage, there's what we bought, you know, the easier it is for us to prove it, the more we can feel comfortable that it's a tax deduction that we can defend. In your case, David, it's a good example. I forget exactly what, but I think you said you had 100,000, you borrowed 300 or something, and you ended up. What was your?
Well, let's say
comment?
I have one mortgage, so I've refinanced my house.
Yeah.
And now I have a new, like instead of having a $300,000 mortgage, now I have a $400,000 mortgage.
Okay.
I get $100,000 back. I use that as a down payment on the investment property, but going forward, the interest on that $100,000, it's mingled with the $300,000 of debt that I originally had on my principal residence.
Okay, so you had a mortgage of 300 grand on your principal residence, which let's assume is not tax deductible. You borrowed the money to buy your principal residence, period. Now you go to the bank, refinance, give me $100,000, and they go up to 400,000 on your mortgage, and it's all one mortgage. Okay, now as long as our audit trail is very clear. Okay, you get the check from the bank for $100,000. You put that $100,000 into an investment. So far, we have no problem. We can deduct a quarter of your interest on the $400,000. And as long as it remains that clean, we're not going to have a problem with CRA. The minute we muddy the waters by taking that 100,000 and doing something else, and whether that's questionable, whether it's investment or personal, as soon as we muddy the waters, we're going to have a problem with CRA. Okay, and when we get an audit from CRA, here's how it kind of works in simple terms, and we'll use your example. Let's say we do that and we deduct the interest, and let's be honest, the minute we put interest deductibility on a personal tax return, there's some flags that go off at CRA to go, oh, what's this person doing? Oh, we better have a look at this person. So next thing you know, let's just assume we're being questioned on that transaction. So now we get CRA coming. Out of 10 CRA auditors, 7 of them are probably reasonable and easy enough to work with. And we're going, hey, look, this is what happened. Here's the, okay. And 7 out of 10 are going to go, all right, no problem. Thank you. See you later. Bye. Then you get the 3 out of 10 or 2 out of 10 that are out to change the world. They've been given some power that they've never had in their life. And here we go. We're dealing with somebody that, and they got a much heavier stick than we do. So they're going to come in and they're going to say, no, you can't do that. You get a reassessment on the tax return. They pulled it off your tax return. We as accountants talk to the client, go, hey, client, I really don't see a problem with this. So now we got to fight with CRA. We have our first step is to file a notice of objection, which basically says, sorry, CRA, we don't agree with that, what that auditor did. And we're really fighting with the CRA. We're fighting with the same entity that just denied this expense. So that's always fun. And once we go beyond that, if we lose at the notice of objection stage, we have to go to the tax courts. And now the client is spending money, and 99.9% of the people, if they lose at the notice of objection level, are not going to spend the money, or not going to take the time, or just have zero desire to go through the tax court system. So again, back to, the big thing to take from this is you need to have a very clean audit trail. That's important. We're in a self-assessing system, which means we get to self-assess ourselves. Yes, we think that interest is tax deductible, and it is based on the criteria of the Income Tax Act, but we have to be able to prove it. And the cleaner your audit trail is, the more success you're going to have. I'd actually like to jump back if I can. You're talking about the 65-year-old. If I can jump back there. Sure. Neal keeps hitting these golden nuggets comments. Okay, he said something, I don't know exactly what you said, smoothing out income. I think you said that's a golden nugget. Okay, because whether that client is 65 or 25, it's not as much about the age. It's more about the income. And as we deal with senior clients, 60, 65, all of a sudden the tax system gives them Canada Pension, gives them old age security. If they have an RSP, the system says you have to take that money out of your RSP. So all of a sudden you're getting up into the level of income. So in my world, I always look at every person. Okay, I look at all my personal tax clients, and say you got 4 tax brackets. You got a 20% bracket, which is basically $0 to $50,000 of taxable income. You got a 30% bracket, 50 to 100,000. You got a 40% bracket, 100 to 150,000. And if you earn over 150, you're in a 50% bracket. These are guidelines. These are not real numbers, but they're pretty close. So now you go back to that senior who might have old age security, Canada Pension, some RIFs, and if you've done good for yourself, you're going to be pulling money out of the RSP. Now we got to look at that person's tax bracket. If they're going to get pushed up into a 30% bracket or a 40% bracket, and this 65-year-old realtor or person can flow income through a corporation at 12.5%, we're saving a lot of money for that person. So it's not so much the age, it is the income. Again, Neal said it best, smoothing out your income over your life is the key. That's what saves you taxes. A corporation, I'll repeat it again, just gives us more tools to accomplish that. If you do not have a corporation, we don't have the tools that we need to smooth out your income over your life. The example I just stated is one reason why I'll be very bold. I do not like RSPs, okay? And for one of the reasons, I just see so many people that put money into their RSPs. They are ticking time bombs. Okay, when somebody says, oh, I've got $500,000 in my RSP, yeah, well, but you're going to die one day and that money's going to go to your kids and they're going to pay as much as 50% tax. So the one problem I have with RSPs is they've been used in the industry as nothing more than a sales tool to get you to put money into the RSPs, so all these big banks can make crazy management fees on your money in their mutual funds. The only time I like RSPs, understand with an RSP, you have money going in and you have money coming out. If you put money into an RSP and save 50% tax or even 40% tax, great, let's do it. But when you put money into an RSP and save 20% tax, there is zero reason to do that, okay? Because you're going to be in a minimum 20% tax bracket for the rest of your life. So when we smooth out income, it makes no sense to go into an RSP at 20% and it comes out at 20, 30, 40, 50. I'm somebody that's done probably over 400 terminal final death tax returns over my life. And I'm the one that gets to sit with the children and go, gee, sorry about your parents. They had $500,000 in their RSP and we got to cut a check of $250,000 to CRA. And the look on these people's faces, it's horrible. Yeah. And all that, most of that problem could have been avoided with some proper planning throughout the life. You do not need RSPs to build a good retirement income. You have a corporation. It is a much better RSP to build your retirement income. Only use RSPs if you have no other choice and if you're in a 40 or 50% tax bracket. Now we can introduce an RSP into your planning model.
Okay, thank you, Gerry. There's a question from Sarah.
Can I add one quick?
Yeah, go ahead, Neal, for sure.
This is why also TFSA is still should be part of the so like plan for any realtor or anyone really. Even with the corporation, I always still recommend to all my clients, it's pretty much a no-brainer to max out your TFSA every year, no matter what tax bracket you're in. And I still think it's worth it to take that money, even if it's $6,000 out of the corporation, pay the personal tax, put it into your TFSA, do that every year, both spouses. I still always recommend that. Just to, I just wanted to, just make sure people don't forget about the TFSA.
Sounds like a good suggestion. Here's a comment from Sarah Daniel. She says, hi, Gerry, but I think, either of you can comment on this. I think you once mentioned that one would pay virtually no personal income tax, pardon me, if one takes a dividend. However, our accountant said because of the principle of integration, that the net tax paid would be the same. Please, would you talk about this concept and how it would relate to your comment? Thank you, Sarah Daniel.
Okay, thanks, Sarah. Yeah, good comment. So up to a certain, okay, so let me back up a bit. We have a corporation. We need to take money out of that corporation personally. Okay, so again, what I said before, we can take it out as a salary, which you're going to get a T4 for. That is tax deductible to the corp, which means we're going to reduce the corporate income by how much we give you as a salary. And we'll use $50,000 as an example. All your income flows through your corp. At the end of the year, you need $50,000. If we take it out as a salary, we reduce the corporate income by $50,000, and that $50,000 becomes taxable to you personally. The other option we have is a dividend. Okay, so you earn whatever income you earn, less your expenses, you have net income in the corporation. Now we're going to pay 12.2% on that net income in the corporation. Now we give you a dividend. A dividend is not tax deductible to the corporation. Okay, so in order for the tax system to be fair, the tax system basically says, oh, you're taking money out of the corporation that has already been tax paid. So we're going to give you a dividend tax credit for the tax that's already been paid in the corporation. So we give you the dividend, you get a dividend tax credit, which is a mechanism that we accountants learn go through, but it's in simple terms, it's a tax credit for the money that the corporation has already paid. And there are some advantages to this dividend tax credit. 50,000 as far as receiving a dividend tax free, it's not really 50, it's probably closer to 40. But even a $50,000 dividend would result in you paying a very low personal tax rate, but you could take out about $40,000 tax free from the corporation as a dividend. And now the total tax paid on that 40,000 would have been 12.2%. The income flows through the corp. Again, think of it as your income flowing through the corp first. Then we can make all kinds of decisions. We as accountants have tools to determine what we do with that income. But in our example, the income flows through the corporation. We've decided to take a $40,000 dividend. So the income flows through the corp. The corp will pay 12.2% tax on that income. We give ourselves a $40,000 dividend. We're paying basically zero personal income tax on that $40,000. And as I mentioned before, we are not paying any Canada pension. Okay, that's important. Okay, so if we did go back now, for that 40,000 goes through the corporation, we pay the corporate tax. Sorry, if it goes through the corporation, if we do it as a salary, we get a deduction on the corp. So then we reduce the corporate tax by that 12. We put it on the personal tax return. You're going to pay personal tax. You're in your 20% bracket. You're going to also pay Canada pension. You're going to pay a lot more tax on the salary. So I don't know if that answered the question or made it more confusing, but if Neal wants to jump in on that, maybe make it
Sarah,
less. Sarah,
if you want, if there's more to it than that, you can let us know. Neal, do you want to comment on that, or?
There's another strategy that not necessarily to do with the corporation, but I once read about it and I was like kind of upset that I didn't think about it myself. But the favorable tax rate on dividends also can allow you to, let's say, I'll just give an example. Let's say you have zero personal income, okay? You have nothing, but let's say you won the lottery and you won $1 million. And let's say you invest that $1 million in a non-registered investment account personally. So just a regular investment account. And you invest it all in dividend paying stocks, publicly traded Canadian dividend paying stocks like the big banks and, you know, all sorts of Canadian stocks that pay dividends. And let's just say theoretically, you earned 8% dividends. Okay, so you have an investment portfolio of $1 million and you earn $80,000 of dividend income in a year. Okay, and those are called eligible dividends. It gets a little complicated, eligible dividend, non-eligible, so we won't get into the details. But let's say you earned $80,000 of dividend income from these publicly traded Canadian stocks, and you have no other personal income. You don't work, you don't have self-employment income, no employment income, nothing. On $80,000 of dividends from those publicly traded companies, you might only pay like $3,000 or $4,000 or $5,000 of income tax, maybe a tiny bit more. It's a very low rate, and that's because of what Gerry was saying. This thing called the dividend tax credit, and the dividend tax credit is to take into account that the corporation you earned the dividend from paid income tax on that money already. Okay, so if you earn, another example to compare it. If you work hard and you earn $80,000 of T4 employment income or self-employment income in Ontario, you'll pay approximately, I don't know, 18,000, maybe $20,000 of tax plus CPP. So our tax system in Canada, in a certain sense, is very progressive. Like the more you earn, the more you pay, right? And we have very high tax rates. But there's all these little kinks in the system that kind of that are very sort of strange when you think about it. Why should someone who earns $80,000 of employment income, they work hard, they work all day, they sweat, they have to pay $20,000 of tax, let's say, whereas you sit back and relax and you have your $1 million lottery winnings, which were tax-free in Canada, and you invested and you earn dividends, you only pay, less than 10% tax. But it's just another strategy. And by the way, I've seen some political parties propose, and some of these very kind of sort of left-wing think tanks and organizations are proposing to eliminate and abolish the dividend tax credit for this precise reason, because they feel it's advantaging people who don't necessarily need that advantage. And that's a whole other conversation, whether that's true or not. But this could be a strategy, like Gerry was saying, he doesn't like the RSP so much. This could be another strategy that you could have non-registered investments. Again, this really only works assuming you don't really have other personal income. Because again, capital gains also, we know, are taxed favorably as well, because only half of the gain is taxable. So dividends and capital gains are the type of investment income from a tax perspective that you want, whereas interest income is fully taxable. But dividends, you get this nice dividend tax credit. Capital gains, half of it is tax-free. So another strategy is you can build up a portfolio of non-registered investments, and assuming you have zero or very low other personal income, that could be an effective strategy as well.
Thank you, Neal. Gerry, can you talk to us a bit about investing inside of a corp? What are some of the investments you're recommending? I mean, as an accountant, it's unique that you have a company, Canadian Investment Services. And I also wanted to ask you, does it make a difference if it's passive income or active income?
Yeah, thanks, David. So we do provide investment services. It's not so much what we take a different approach to investing, and I don't want to go into a deep dive, but it's not so much what we want the clients in. We really provide a lot of information and education to clients to make sure they're invested what they want to be invested in. So we're not selling nothing. We have access to everything. But our business model is to give you the education and the information, the proper, unbiased. We talk about the good and the bad of any investment. Then you decide what investment that you want to be involved in. Most of us like real estate. Okay, so at Canadian Investment Services, we create our own real estate. Some of the real estate products that we have available for clients are created internally by ourselves, and others are accessed through third parties. So for example, ourselves, we do some fix and flips. We've done 4 fix and flip projects in the last 2 years. And with these type of projects, we bring in joint venture, we bring in clients We buy a house, we knock it down, we rebuild it, and the income is dependent on how we did in that project. So that's just one example. We've just firmed up on a 29-unit apartment building in Alberta, which again, internally we've done that, and we basically wrap that around in a joint venture for those clients that are interested. It really depends only if the client is interested. We're working with a developer in Penetang. They have 56 units that will be built. The permits are just going through now. So these are investment opportunities for our investments, for our investor client. All of these types of investments can be held and paid for through a corporation. Now, we also go to third parties. Again, some of the real estate investments we create ourselves. But I mean, I've said it before, and I've said it many times. One of my favorite type of real estate investments is real estate income trusts. And for those of you that might not be familiar with the real estate income trust, it's really just a fund of apartment buildings. And we all understand, I would assume most of us like real estate. The majority of us probably have owned a rental property, and an apartment fund is no different. They collect rental income, they pay the expenses applicable to that apartment. And then there's net rent. Those of us that are landlords, we've all experienced that. And inside of these funds, the net rent is either distributed to the investors by way of what we call return of capital, which is a beautiful thing, or it's reinvested within the fund. So real estate investment trust, just my opinion, is something that if you're not familiar with them, you should really educate yourself about them. They're fantastic investments. There's good real estate income trusts. There's bad real estate income trusts. You really need to dig a little bit deeper. It's not a general comment, oh, everybody should go invest in real estate income trusts. Everybody should invest in good real estate income trusts, assuming that is an investment that you want to be invested in. So again, it's important to educate yourself. We have different clients. Some clients are like, here's my money, I'm too busy, do something with it, no problem, we do that. But again, we're really a company that wants to give you education. The minute, I always say to everybody, the minute you pull your money out of clients want no risk and they want to make 10%. It doesn't exist, okay? If you want no risk, you keep your money in a GIC earning 1%, and there is no risk. The minute you take your money out of that investment and go into any type of investment, there is risk. And one way, in our opinion, to mitigate that risk, we have to do our due diligence, of course, with the years of experience that we have. But another way to mitigate risk with a client is to make sure they understand the good and the bad about that investment. The worst thing that can happen to a client, in our opinion, is that something happens in their investment that they weren't aware of, okay? That is not good, okay? So you got to know everything, the good and the bad. When I talk about REITs, there's private REITs and public REITs, okay? So I prefer the private REITs, okay? And I prefer the private REITs because they simply have zero correlation to the stock market. I do not like the stock market. You can make a lot of money in the stock market, agreed. But the stock market has an abundance of risk that nobody tells you about. Okay, back in my day at Deloitte Touche, we used to work with a lot of IPO offerings, initial public offerings. To make a long story short, we'd go in there, we'd value the company, we'd take that company public. And by the time they hit the stock market, whatever their share is trading at is much less than the real value of the company. So in my opinion, pretty well all the companies that are trading on the publicly traded stock market are well overvalued based on their capitalized rate to what the real liquidated value is of that company. And we don't have to go back too far. Nortel is the best example. Trading at $125, and then oops, something went wrong. They had to liquidate the company, and the real value of that company ended up being 66 cents. And that was a blue chip stock. So I try not to use the stock market for our investment strategies. I like private REITs simply because they have no correlation to the publicly traded stock market. Plus, the private REITs are more focused on an area. So for example, we deal with a lot of REITs that might, I like the 2-hour radius outside of Toronto. Okay, you go to a map and then you go from Niagara Falls, London, Kitchener, Owen Sound, to really to Peterborough in towards the GTA. All of those towns in that area, any apartment building in those towns, as long as they're good, but most of these, that's a gold mine as far as creating a real estate income trust. And especially when you look at what's happened in the last 2 years, we are now $1.3 trillion in debt. That is just mind-boggling and astronomical. And you just shake your head at the money they're printing. But then you think of it from an investment point of view, what does all that mean? Okay, well, when they have this kind of debt, they're always trying to, justify it by debt to GDP. So, one way to deal with this debt is to create economic activity. And one way to create economic activity is to open the borders and let the immigrants come in. And that's exactly what Trudeau has said, 1.2 new immigrants coming into Canada over the next 3 years. Okay, what the heck does that mean when we're talking about a real estate income trust? It means a lot, because 1.2 million people coming to Canada, most of them are going to land in the GTA. Some will be able to afford houses, most will not. They're going to land in apartment buildings. And those apartment buildings, we see what's happened to the rent already. Okay, wait to see what happens in the next 2 or 3 years with the rent. So to build an investment strategy around that type of system where, okay, rents, vacancies, I have a bunch of rental units, 0 vacancy rate. The minute a tenant moves out, I get to jump that rent up to fair market value. It's an incredible business model. And if you wrap it into an investment strategy, and then you get talking about personal corporations, real estate corporations, we can do all that stuff within a personal real estate corp. I see no reason why, it's funny, people, when we talk about the stock, well, I need to be diversified and everything else. And okay, I get it to a certain degree. This might be a bold comment, but diversification is also maybe for somebody that doesn't know what they're doing. If you know what you're doing, I have no problem. All my money is in real estate. I have 0 money in the stock market. So to have all your money in real estate, to me, is not a bad thing. You don't need to be diversified if you know what you're doing.
Okay, Gerry. Gerry, there's a question from Sarah, and then give us your closing thoughts because we're behind, and then we'll go to Neal. Neal, we're going to give you the last word and closing thoughts. But Gerry, if you'd comment on this follow-up question from Sarah, she says, in follow-up to Gerry's comment, would the 0% personal tax payable only apply to dividends up to $40,000? And then would the principle of integration would apply?
Okay, thanks, Sarah. Yeah, so my comments about $40,000 taking out dividends, $40,000 of dividend tax free assumes that there's no other income. Okay, so the principle of integration really is the tax system saying, okay, we have a person and we have a corporation. And again, with the realtors out there, your income now flows through a PREC. So the integration says your income flows through the PREC. If you pay corporate tax at 12.2, we're not going to penalize you when you take that money out to double tax. There is no double tax. So the concept of integration is the tax system saying we recognize your income flows through the corporation. We recognize that if you choose to pay corporate tax at 12.2, if that's the strategizing that your accountant does, then we're not going to penalize you personally by taxing you again. Okay, so now with that said, a lot of it depends what income level you are personally. So again, what I talked about, Sarah, was assuming you had 0 other income, then we can pull out a $40,000 dividend without paying any personal tax. And that's really the principle of integration. So there's a magic number. Again, it's a tool that we have, and we can figure out a magic number where the magic happens as far as you receiving a dividend personally. if you have a whole bunch of other income on your tax return already, you got this income, whatever, then the taking out dividends tax-free from your corp isn't going to work as well. But it's okay because it still gives us a tool. And I go back to what Neal said earlier. The key in all of this is smoothing out your income. That's the key, making sure that you're paying in as low a tax bracket as possible. There's also income splitting strategies. Now, the Liberals messed around with that. I don't want to get into it too much, but we do want to, we want to make sure everybody, like when I do a tax return, personal tax return, I want to make sure everybody in this household is paying in the same bracket. Okay, if we have one spouse up here and one spouse down here, we're missing opportunity. Now, in some cases, we can't do anything about it. But if we have corporations, we have another tool. If there's the ability to split some income with spouses, we save a lot of money if we can smooth out the income and having both people in both spouses and even kids. We can draw kids into this. Once again, the Liberals messed up some of our tax planning strategies when they were messing around with all this stuff. But again, a golden nugget, smooth out your income. That's the key.
Okay, thanks, Gerry. Neal, if you would give us your final thoughts. We're a little behind schedule, and I know you guys got to get back to work. I also just want to say hello to not all of you friends, and also Ernest from Portugal. He's been off living the dream, expanding EXP this year. So hello to Ernest and hello to everybody. Neal, give us your final thoughts, if you would, please.
I just wanted to comment on the REITs, the real estate income trust that Gerry was mentioning. I actually love REITs also. The nice thing about them, at least the publicly traded ones, you can hold them in your TFSA or in a registered investment account. So, and they typically pay very high dividends. And then obviously all those, if they're within your TFSA or within your RRSP or your children's RESP, those dividends are all tax-free. So I think REITs are great. And even some of the private REITs, you might, depending on how they're structured, sometimes you could invest in like these private real estate deals where it's actually TFSA eligible or RRSP eligible, depending on how it's structured. So that's very advantaged. And the only other concluding thought I have is if you're interested in the idea that Canada's tax system is a completely horribly complicated mess, then I think you will like my book that I wrote, The Grumpy Accountant, and it's available on Amazon.ca and on Indigo.ca, and you could check out my website at grumpyaccountant.ca to learn more about the book. And if anyone's a Seinfeld fan, a fan of this TV show Seinfeld, they will also enjoy the book because the characters in the book are Gerry and George and Elaine. I didn't use Kramer because I didn't want to get sued. So it's just Gerry, George, Elaine. There's Frank and Pam. So Seinfeld fans will like the book. And it's about a movement, how we can simplify the tax system, make it a lot simpler and easier for people. So I would encourage people to check it out if they're interested.
Okay, awesome, guys. Thanks again for your time. And just to remind people, if anybody needs assistance with a mortgage, to give me a call, or if you want to learn more about private REITs or other private investments, give me a call as well, because I'm also a licensed dealing representative. And it's been great. There were other questions like what are the costs to set up a corporation, but I'm going to encourage people to call Gerry and or Neal directly for more information. We did our best to get to all the questions. We may not have answered all of them, but I would encourage you to reach out to Neal and Gerry directly. Can I circulate their number? Yeah, I'll put it up one more time here. I think I've posted this before, but here it is again. You can see, take a snapshot, grab your cell phone if you want, and you got everybody's contact information. So guys, thanks again. And thanks everybody for joining today. Enjoy the beautiful weather out there. Good luck getting your taxes in on time. And Neal and Gerry, we'll see you guys another time.
Thanks very much. Thank you.
Thank
Thank you,
you.
Dave. Thanks, everyone.
Thanks a lot.